Hello there, Chris Koshy here. In 2025, our team is trying something new. Quarterly video updates just for you, our valued clients. These updates will cover market insights, planning opportunities, and important topics to keep us all aligned and informed. Our goal is simple, to provide you valuable information to help you and your family stay educated and confident in your financial journey. Today, we're excited to kick things off with Max Mann, Portfolio Manager of the Specialized Asset Management Team. Max, thanks so much for joining us today.
Happy to be here. Thanks for having me, Chris.
Absolutely. So in 2024, the market really started at a place where there was peak pessimism that was taking place. The market actually performed very well, almost up 25%, and there was very little volatility that took place. Do you mind sharing a couple things that stood out to you as we looked at the year of 2024?
A couple interesting things that stood out to me. There were 57 new all-time highs last year. So literally 20% of all trading days, you got an all-time high in the market. I think the Fed discussion is interesting. You're going to hear me constantly say that we don't know what the Fed's going to do, and candidly, no one else does either. But you did start the year thinking you'd get 7 or 8 cuts. And then we finally got one in September, ended up with 4. So I think summarizing it, expectations were low, growth exceeded expectations. A lot of those macro concerns got better throughout the year. Inflation came down, the Fed did start cutting rates. We got through the election. There's kind of a pro-growth narrative post-election, which was well received. But certainly we're thankful for 20% plus returns in a year like that.
Absolutely, yeah, I think we're all thankful for that. So as we look in your Sam quarterly commentary video, you mentioned about the Magnificent Seven and some of the strength of these businesses. I saw a chart from Sonu Varghese at Carson Research that essentially showed the S&P total return was almost 25%, but 11.7% of the total return came from the S&P 490, outside of the Magnificent Seven. I think your team is taking that as a really good sign as we look to 2025.
We certainly are, and we think a theme that could emerge during 25 is a broader market. And it certainly is healthy if 500 companies contribute to the return versus just these top 7. So just for listeners, the Magnificent Seven, these are the 7 largest companies in the market. A lot of them are technology businesses. So the profitability of these companies is twice what the other 493 companies have from a profit margin perspective. These companies generate a ton of cash. They're self-funding, which means interest rates are less relevant to them. So they can fund their growth through cash investments. They can return cash to us because of how much they're generating. I think artificial intelligence is a big topic that maybe we'll talk about, but the amount of cash these companies are generating allows them to make these large investments within artificial intelligence, which theoretically extends their moat, extends their ability to innovate, and I think can keep them in a leadership position maybe longer than past cycles have indicated.
Yeah, I think it's clear that the Magnificent Seven and the companies that make up the S&P 500, they don't want to be left behind. And so there is substantial investment taking place. They don't want a repeat of what happened in 2000 where there was the haves and the have-nots. And so we're seeing substantial investment in the artificial intelligence space, and I think that's a really good sign.
We agree.
Yeah.
We agree. And we have no idea what happens short term with any of these businesses, but we think when you have tremendous profit margins, you're generating tremendous cash. There are many elements of today's market in these companies that feel very different than maybe what we've seen in past cycles.
That makes sense. You had mentioned that you do expect some market volatility to take place in 2025. Do you mind talking about that a little bit?
Yes. So we can talk through how this happens very commonly. So in any typical year, you get at least one 10% pullback, you get multiple 5% pullbacks. We haven't had that for a couple years. So part of what we're talking about here is just a normal cadence. I think the other piece of this is volatility is the toll we pay for long-term returns. When the market pulls back, our job is to upgrade quality and growth rates of our portfolios, and we would very much welcome that opportunity. Doesn't mean it's going to happen, but history would say that it's a reasonable idea, and if clients are ready for it, they're prepared to stick to their plan, they understand there's a quality bias to what we're doing, I think everyone's in a better position to take advantage of long-term opportunities.
So I think what you're trying to say is that a market pullback is both normal and it's healthy.
Yes, we think it would be very healthy and normal if that took place.
That's great. I think our investors can really take that to heart as we think about 2025 and how that impacts investment portfolios, but also how that fits into clients' tax plans and financial plans here for 2025.
Right.
Max, I wanted to thank you so much for joining us for today's conversation.
Happy to be here. Thanks for having me.
If you've made it this far, you may be wondering, what does this mean for me? Our hope in sharing this information is to educate you with a few things that we pay attention to from a market perspective, to remind you that market pullbacks are normal and indeed healthy, and to share that there is no way to predict what will happen in the future. We believe that our financial and tax plan that we custom tailor to you allows you to weather any storm. As we look into this year, we want to thank you for your trust and partnership. We would love to hear any feedback, as we hope to provide you trustworthy information to keep you informed. Thanks so much for watching.